Hello, Smart Money Tree podcast listeners. Welcome to the show. My name is Kirk Chisholm. I'll be your host, and today I'm joined with my good friend Doug Heagren. Hey, Doug.
Hey, Kirk, another happy Friday to you. Back again to talk about the most exciting thing in everybody's mind, money.
Money. Yeah. Happy Friday to you too, Doug. And
Thanks.
I was looking at the date. It is April 12th, and I'm very happy it wasn't April 13th. Like we missed it by a day.
That's right. That's
And
right. We already had a solar eclipse that came through earlier, and that people are blaming global warming on. By the way, I don't know if you've heard that
I didn't
when
hear that, Doug.
there are people out there that are commenting about the solar eclipse and saying another sign of the impending problem of global warming. Just again, if we want to go down a diatribe on the quality of education in this world, but anyway, that being said, we don't need to deal with Friday the 13th at the same time that we got a solar apocalypse coming on. That came and went, and I don't remember people disappearing into the clouds. So I guess it turned out to be not quite the cataclysmic event that some people were predicting. So here we are
Yeah.
today.
No, that's great news, Doug. And in other news, it's just determined that the world is now flat. So let's let's, we're sorry, we're not going to turn into a major media station here. But 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 seriously, like the solar eclipse, I mean, if that was on Friday the 13th, we probably would have had like 50 million people out there saying the world was going to end. So it's just we're human beings and we're crazy. That's just that's just the species that we are. But anyway, no, it was interesting. The solar eclipse was kind of cool. Of course, I tried to look at it without sunglasses. That didn't go too well, but we did get some of those solar shades, which was kind of weird. I was afraid to look through them, and I looked through them. I was like, wow, you really. It's like I don't know if you with the welder shades where you can't.
It's a
It's
welder
kind of like a
mask.
welder mask, yeah. Like you
You
can't see
can't see
anything.
anything
It's
unless you're looking at that light.
Yeah, and the sun, you could clearly see the sun part of it, which it was kind of cool, but I was like, it's disappointing.
Mm-hmm.
Like if I had driven 200 miles to go stay at a hotel and watch that, I probably would have been disappointed.
Yeah.
So,
Here's some deep thoughts by Jack Handy for you. So, when the moon is going through, if a full moon creates a solar eclipse, and as it's creating a solar eclipse, it creates a crescent sun. What happens if you have a crescent moon during a solar eclipse?
hmm, the
Deep
deep
thoughts.
thoughts. Deep thoughts. Wow. All right.
Moving
Well,
on. Hey,
moving on.
hey, I just going a little retro for any of you out there that remember Deep Thoughts with Jack Handy, one of the greatest skits in Saturday Night Live history. So
Yeah, I have to say the old Saturday Night Live stuff. I miss you, Doug. Like we haven't talked like this in a few weeks, so this is great. Yeah, the old Jack Handy, the news, the Saturday Night Live news. I need my stack of papers so I can just kind of go like this at the end of a joke. All right,
yeah,
you know.
exactly. Little Dennis Miller,
Yeah, a little Dennis Miller. All right, and who was it?
and then
Teddy
and then we
Stewart
could
used
and
to
then we
take
could
it and
follow it
throw it.
and then we could follow that up by offending everybody like Norm Macdonald. So
Yeah.
yeah,
Rest in peace, Norm. And
amen.
in other news, I might as well. This is a good segue into rest in peace. For those of you who are not following this, Daniel Kahneman, who is really well known as the father of behavioral economics, passed away at the age of 90. I think it was a few weeks ago. I got that. I think it was yeah, it was 3 weeks ago. I think he died. For those of you who don't know him or who he was, you should really look into him. He wrote a book, Thinking Fast, Thinking Slow, which is brilliant, but he really changed the way we think about behavioral economics. And I'm trying to put my finger on this news article I was reading the other day about it, but really it was like the dark ages versus today. It was such a different place than it is now. Like people didn't view the markets in the same way. People thought so as having a degree in economics, I can make fun of myself. Apparently, that is socially acceptable. So I'm going to make fun of all the economists out there because that's my background. Is that if you learn in economics 101, what they teach you is that markets are efficient because all information is known by all market participants. Well, if you live in a test tube and there's a vacuum in there and everything's perfect and there's no errant behavior, yeah, sure, that makes sense. But we don't live in that world, and in a real world, most people are not informed. and there are people who are highly informed who pay lots of money to be highly informed. So we don't really have an efficient market in the economist textbook sense of the world. Um, and also, people aren't rational, which is also an assumption that people make, is that there's rationality in buying decisions. And anyone who's been around any other human being for more than 5 minutes know that we are not we are not rational beings at all. I think spending 5 seconds in politics will tell you that. Going to the store will tell you that. Warren Buffett's phrasing, which I always love, which is the markets are the only place where when things go on sale, people don't want them, and when they're overpriced, people go and buy. Right? Like we're not rational people. We do not make rational buying decisions. We should, but we don't.
Another way of saying that, Kirk, and that I've heard is, it's the only time that if you went to the grocery store and lemons were 10 lemons for $1, right? You would buy as many as you could. But when they're 10 lemons for $10, you wouldn't buy them. But in the stock market, irrationally, what do? We decide we're going to buy more lemons when they're at a higher price per lemon. It's
Right.
the irrationality of it because of the comfort of investing where things are already overpriced. That's kind of a simpler kind of way of bringing that Warren Buffett quote back home.
Right. And so what Kahneman really did was show a lot of the biases that we have, the behavioral biases or the cognitive biases that we like to talk about on the show, is there are tons of cognitive biases out there. And he really used experiments to show this. And so his book is like reading a textbook. It's long. And I saw a quote last week that said, out of all the people that bought his book, only 7% have actually finished it. I don't know how they got that statistic, but I find it's funny more than anything else. And I always look at these surveys as total garbage, but they're funny, right? It's like only 7% of the people have ever finished his book.
Are they
Okay.
counting him? Are they counting him as one of them?
Yeah, I mean, yeah, him 7 times. Yeah, I mean, it's a great book, by the way, and I haven't finished it either, so I'm in the 93%. But it's a great book, and I'll say that any investor who really wants to become a better investor, it should be on your must-read list. Even if you don't finish it, there's tons that can be gleaned from there. So I just wanted to raise a mug for Daniel Kahneman for changing our industry for the better. There aren't many people out there, and there aren't many economists, especially, who do that. But he's definitely one. So kudos, Daniel Kahneman, for all your good work. So moving on, let's talk about a few things. We got some. Doug's been absent for a while, so I've been a little neglecting some of these good charts he's been sending me. So I wanted to start off with one of them here, which last week we talked about Apple, and of course we're not recommending you buy or sell Apple, but we're using it as an example, partially because I found this chart. So I wanted to share it as a way to understand how to look at investing in a different lens. All right, so here's a chart I found, and it's basically, so there's a few ways to look at, sorry, I'm not even sharing yet. That's another thing I did last week. I talked for 10 minutes about a chart, and I thought I was sharing it and wasn't. So thank you for all you listeners who didn't comment on that. So anyway, all right. So there's this thing in finance, which is comparison, or you could think of it as opportunity cost. Now, here's the way we look at it. Everyone who invests has a different framework that they use to decide what is a good buying decision or not. If you're a technical analyst or if you're a technical investor, you're looking at the technicals, you're looking at the moving averages, you're looking at price points, is buying and selling, all that. Many technical analysts don't even look at what the stock is. They don't care. They don't want to know what the stock is. They just look at the chart. And that has validity, or else people wouldn't do it, right? So you could say, well, it doesn't make sense. Who cares if it makes sense? Is it working? Are there people who are using it? Absolutely, there are. And there are people who make money fundamental analysis. So there's no right or wrong. It's just what works for you. So from a technical perspective, some of the things that they use are comparisons. They might look at how's gold doing to the S&P 500, or how is Tesla doing to the Chinese stock market, or whatever people do. I mean, that last one was nonsense. But people try to find, if you're looking at 20 stocks, you look at them independently, and then you look at them in comparison to each other. Because if you can only buy one out of the 20, how do you decide which is the best? We could say, well, this one has the best fundamentals. Okay, but what if it's not? What if the stock price isn't going up? For one reason or another, the stock market participants have decided that for the next 6 months, that stock is not going to grow, which is why the stock price isn't going up. And Apple is actually a good example because the stock price is down this year. I think it's down 9% or 10% for the year. In comparison to everything else, which is why we're showing this chart. So I'm mainly using it because it's the largest company out there. I'm not using it because it's good or bad, just for illustrative purposes. So if you look at 10 stocks and you have to pick one way that you can consider it is look at each one in comparison to the index. Let's say the S&P 500, for example, and you see how are they doing. And in a stock like this, is actually not a good idea because it's better to pick the S&P 500 because the comparison stock is down in comparison to the S&P, which means that the market as a whole is doing better than this stock. So what they'll do is they'll take a stock and they'll compare it and they'll look at all these charts together and let's say, all right, these charts are bad, let's discount these. These charts look good, let's look at these few. And so from a technical perspective, you're looking at what's your opportunity cost. So if I'm looking at, let's say, gold versus silver, and gold is doing better comparison to silver, and I don't have this chart in front of me, or I would show it, you'd say, all right, gold's doing better, so I should invest in gold. Or silver's doing better, I should over allocate into silver. That is a very common practice for people who use technical analysis for investing. So for those of you audio viewers here, let me explain the chart. So what it is it's basically a ratio of Apple to the S&P 500 or the SPY. So it's AAPL versus SPY. So it's showing that for the latter, basically last year, Apple outperformed the S&P, which was expected. That is what had happened. And then the latter part of last year, it went down and more or less sideways till the end of the year. But since January, it's actually it's gone down in comparison to the S&P. Now, does that mean the stock price has gone down? No. What it means is if you look at the stock price, actually, the stock price has gone sideways. It's down a little for the year. I'm not going to lie. I'm actually going to bring up a chart and show you for the year how it's done. You'll see it hasn't done badly. It's just in comparison to everything else, it has not done great. So let me share this. And here we go. All right. So here's Apple, right? So going sideways. So pretty much up until last year, it was sideways. This year, it's trending down. Okay. That's Apple. Now, if you compare that to the S&P 500, here's last year. It was more or less sideways, more or less down in going into November, and then November it's kind of gone up until recently. So if we look at this, what this is showing is the S&P has gone up, and if you look at Apple, Apple has gone down in price since the beginning of the year. I think it started here, 186, and right now it's 175. So it's lower, right? So if you go back to this chart that I was showing before, and this time I'll actually try to show it. What you're going to see is that Apple, in comparison to the S&P, is lower. It's gone down. And that's a combination of the S&P going up and Apple going sideways to a little bit lower. So this is how you would look at an individual stock and say, should I buy or continue to own this stock? Well, in comparison, you would have been better off owning the S&P for the last quarter, looking at this chart exclusively. So ratio comparisons are actually really helpful when you're looking at stocks or not stocks or indexes or commodities or different things. I've gotten a lot of really useful information over time looking at this because it shows where your opportunity costs are. So in this case, your opportunity cost would have been better off being in the S&P. But if let's say your comparison is a short term, like a 3-month Treasury ETF versus like a 30-year Treasury ETF. And you can put that comparison together and you can say, well, in comparison, the 3-month has done a lot better than the 30 year because 30 year has gone down a lot. So in comparison, it would have been better off doing this. So it helps to show trends before they start. Because if you have, I'll give you a good example, and I'm going to try to when I hand the mic over to Doug, I'm going to try to actually put this together. But if you look at gold versus silver, what you'll see is that gold has actually outperformed silver pretty handedly. I'm not sure if that's changed. I think silver's actually gone up in the last week, but generally over the last few months, gold has done very well, and silver has pretty much dragged its feet through that period of time. Currently, it's starting to pick up. So, if you're considering should I invest in gold or silver, you say, well, gold's doing well, silver isn't. Maybe there's a reason, right? What is that reason? I don't know. But you should at least look into it further and say, all right, what am I missing? Am I missing something? And it could be the market just hasn't realized it yet. And that's okay, right? You might say, all right, I still like silver. It's going to catch up. But what typically happens is if you get a chart like this, and this is a short-term chart, I didn't create it, so I can't extend it. But if you look at like a multi-year chart, what you'll notice is there are times where one outperforms the other or vice versa. And what you want to notice is if it gets too far away from the mean, the average, then you want to look at and say, all right, maybe this is going to change, right? So gold has outperformed silver for quite some time. And I think the gold to silver ratio, is silver to gold ratio is 80 to 1, something like that, in that range, which is historically high. When it gets to that range, it usually reverses. So when people hit that number, it's like, all right, we should invest in silver. So we've been looking at silver and saying, all right, historically, this is a good place to buy silver. But silver is actually not taking off. Why? What are we missing? And so you have to ask yourself that question. Why is my thesis not coming true? And if it's not coming true, you have to figure out what that is. And it could be that it just needs time, right? It could be it just needs time to delay, or it could be that, they just found the biggest silver deposit ever and it just drives the price down. It could be many things. But if you don't know what that answer is, then you should put a pause on your investment, not just put all your money on black and say, all right, we're going all in, right? You take your time, make your decisions, and think about what it is that is actually out of place in your thesis before you jump in with both feet. Go ahead, Doug. You can chime in while I pull up another chart here.
Yeah, sure. I'll give you a great example that I think is one that's really pertinent and present is natural gas, right? So natural gas is definitely something that has, if anybody's followed it, significantly underperformed for a serious period of time, and it has not shown any signs of turning. Matter of fact, last view, it's continuing to drop because they're talking about excess supply, which, if you look at the impact of what has occurred this past season with El Nino, which is that warming trend that created a very temperate and mild winter for most of the country. Well, when do we use the majority of our natural gas? It is for heating. And therefore, if we don't have to heat as much, and they are, of course, planning the pricing and the futures of natural gas production and supply and demand based on typical winters, and you get into a winter where it is an atypically warm seasonal averages, then natural gas production will overpace the demand and the use of that natural gas. And so it obviously, naturally, retroactively, the price of natural gas has dropped. Okay. And it has plummeted. But again, this is one of those situations where is it a good time technically to get into it? Well, one of those factors from a technical aspect, if you compare natural gas to its historic averages, and if you futures, and if you compare natural gas to obviously to other comparisons like investments of the S&P 500, you're going to see a significant disconnect between that pricing and value. And, again, from a technical standpoint, you might say now it's time to jump in. Right now, from a fundamental standpoint, again, if we're starting to get data about an oversupply that is continuing to be an exacerbated problem, it may or may not be a time to jump into it now, because there may be a continuing effect of the lack of usage from the previous season that may continue to be a drag on where the supply and demand equilibrium is going to have to reset for the future season if those supplies continue to remain high. And obviously, those involved in the natural gas industry are going to have to manage through that bullwhip effect of having a significantly higher supply than demand, then what does that mean for the next upcoming season? And we talked about this when we were talking about bullwhip effect, over the last 2 years with things. It's like, and remember, the bullwhip effect, for those that have been listening for some time, was originally created term from Procter and Gamble trying to anticipate the supply and demand of upcoming season of some of their consumer and commercial products. And again, so now it's okay, if you're a natural gas producer, are you going to not produce anymore because of the oversupply that will then mean that you're going to have to shut down the production? That's going to mean that, okay, any usage is going to drain down the oversupply of natural gas and eventually bring it back to equilibrium. But what if they don't time that right? What if they don't time that to the point in which by the time they are able to adjust for the supply and demand against the diminishing supplies, that now it takes an exceptional amount of time to ramp back up on that production? And now you get into a bullwhip effect of extremely high ratcheting futures prices. So, but what's the timing on that? That's the hard part, because it could take a significant amount of time to drain through. And a lot of that also depends on the decision making of those behind natural gas production. So I think it's a great example that also kind of that also kind of gives gives some insight as to looking at something that, from a technical standpoint, how does that look against its historic averages? How does that look against the comparison in other charts? But obviously, beyond technical, there is a level of diligence that still needs to be taken to look at the fundamental current situations to get a better idea of when might be the time, if any, to take action on that.
Is inflation getting you down? Do you feel like your money is worth less every time you open your wallet? Is shrinkflation frustrating you at the grocery store? Well, I have an answer for you. We're giving away free money. That's right, I said it, free money. I feel like I'm not doing my part to create inflation. Why does the government get to have all the fun? What could be better at increasing inflation than giving away free money? No, I'm not an employee of the Federal Reserve. And no, I'm not an employee of the US government either. And no, I am definitely not printing it myself. But it's free. What more could you ask? Well, you might ask, is it real? Well, yes, it's totally real. I'm holding it in my hands right here, see? Oh, wait, this is a podcast. You can't see it. Either way, I'm holding it in my hands right now, and I want to give it to you. If you want some free money, go to moneytreepodcast.com/free money to get your free money today. Follow the instructions and I'll send some to you. Enjoy your free money today. I'm not the Federal Reserve, so I only have a limited supply. This offer is good until I run out. Go to www.moneytreepodcast.com/free money to get your free money today.
Yeah, so let's dive into a few more things here. I think some really interesting charts here that I want to share, and if I can find them, here we go. So here's a few hot areas that people have been talking about. So gold is obviously a hot area. It's broken out. Not everybody's aware of that, but I think most of you are probably aware of it by now, and you probably know I love gold. So, but here's what I wanted to show. And
he means that because of investing, not the gold chain around his neck, the bling that he wears, just to be clear.
Just let me cover that up there. Yeah, that's yeah. I don't wear that anymore, Doug. That's no longer cool. So anyway, so this chart here, this shows the gold ETF assets. Now, gold itself, you can buy it through futures, you can buy physical. Of course, everyone's got their flair. Everyone wants to. I mean, look, I love buying physical gold. It's great. It's impractical because you need to carry it around, put it in safe, all that. So a lot of people, what they'll do is they'll just buy a gold ETF because it's easy and safe. And so if you look at the GLD, the gold ETF, this is the amount of assets under management in all gold ETFs. So I know there's a few others, but I don't track them. So if you look here from 05 up to 2012, there's a big spike in interest. And by the way, this is the same time that the gold price went through the roof and silver price went through the roof. And right around here in 2008, this is when gold actually was one of, I think, two asset classes that were up for the year in 2008. It was gold and like cash or short-term treasuries, I think, were up. But otherwise, everything else was down. So what's interesting here is that people were kind of conflicted, but then there's a ton of money that came in. Now it crashed, or I don't know if it crashed, but it went down significantly from this period of 2012 to like 2016. Um, and then it started to pick back up again. But it was out of favor for a period of time. And then, of course, it picked up from 16 to 20, and then it really jumped up in 2020, and then it's kind of lagged in interest. Now, what's fascinating about this is not the price of gold. I want to be clear. This is not the price of gold. This is the interest. This is the amount of money going into the paper ETF gold. Okay. Now, this is indicative of price in a certain sense because there's only a certain amount of gold, and this ETFs typically track the spot price of gold. Not to the penny, but close enough that this is why you do it, right? So what's interesting is that there's a huge spike here in 2020 in COVID, and then that's lagged. Yet the price in COVID actually went down, which is kind of funny in of itself. It went down. So if I kind of go back to my COVID chart, 2020, it spiked down right in the middle of COVID, and then it just more or less went sideways, and then kind of went up. And it's basically gone sideways from 2020 until pretty much 2 months ago. And this is despite massive inflation. So we had that 9% inflation spike. Gold didn't take advantage of that. It was really quite surprising, actually. In 2022, I think gold price went down somewhere in the neighborhood of 10, maybe 17, 20%. I mean, crazy. And then it's kind of come back. But the point is the price is not necessarily aligned with the amount of interest in this asset class. Now, of course, you might say, well, doesn't more interest lead to a higher price? It should, but remember, gold is not just invested in ETFs. As Doug says, I might have a big chain around my neck or wedding ring or buying, jewelry for my wife or whatever. Like gold is used in many different ways, right? People have coins, they have bullion, many ways people use gold. The amount in ETFs is not significant enough to move the needle, apparently, according to this, because the amount's going down and yet the price is going up. So that should tell you something. So I did want to point this out because if you look at a similar chart to Bitcoin, and we don't have one because Bitcoin has recently come on as an ETF, I would look forward to seeing this. Bitcoin's a little different because there's a finite amount of Bitcoins out there. And I think it's 19.5 million, I think is what's out there now. So if there's 19.5 million, there's, according to somebody, there's about 2.5 to 3 million that's floating that people are buying and selling, and the rest is socked away that people aren't using. So it's a very small float in comparison to the whole thing. And it was about 15% float, something like that, 15 to 20% float. And if you look at this, so if the interest in this chart, right, if you looked at like 05 to 12, the interest skyrockets, it should lead to a higher price. But in this case, it didn't because there's other factors that come into play and people think the market's manipulated. There's, the world is flat, all this stuff. But, the reality is that it should have an impact if the amount in there is big enough. So the factor you should ask yourself is how much in gold exists. And if it's like 5 or 10% is in this, then you can say, okay, well, that makes sense. If it's 90%, you could say, all right, there's something fishy here. But if you're looking at a rational perspective, let's say you had an ETF in, Bitcoin's the easiest one because we know how many are out there. That one should correlate. There should be, if there's $1 billion in ETFs and there's 2 billion and there's 1 billion held in deep storage in people's pockets, you could say, all right, well, this should dictate the price of Bitcoin. So I use it not in the sense for gold, but because it's a good thing to look at when you're considering assets is this correlated and is this indicative? So if you're seeing a lot of people put money into something, it should drive the price up, right? So if you're investing in, I don't know, XYC stock, and you see the amount of money going in, it means it should be driving the price up because all the shares are traded on the exchange. Well, not all of them, but most of them. So just something to think about as you're looking at investing in assets. It's something that most people don't realize is a thing, but if you do, I think you'll find that it actually will help your investing. I want to mention another chart here real quick because Doug was talking about before the show credit card loans. I'm going to let him talk about it, but I wanted to share this chart first. So here's what we call the high yield spread, and this is basically the corporate bond spread. It shows the difference between corporate and high yield bonds, and the higher the spread, the more risk the market perceives in the bond market. Which means, in easy terms, we talked about Apple versus the S&P 500 earlier. That was comparing Apple stock to the S&P 500. This one is comparing high yield bonds to corporate. I'm not sure if this is corporate or treasuries, but anyway, there's a spread between. I think it's traditionally treasuries, but this kind of chart threw me off a little bit. So it's traditionally treasuries. There's a treasury yield. Let's say it's 5%. Let's say high yield bonds are 8%. Then you'd have a 3% spread. Now, if that 8% turns into 15% and the treasury yields are still at 5, what that means is the bond market sees a tremendous amount of risk in the bond market, in the high yield market, which means that higher risk leads to more volatility and probably lower stock prices and worse economic data. So that's how this spread is used. It's always a great indicator of how the market is doing and where the risk is. So use this indicator, the high yield bond spread, as a way to check out whether the market is perceiving risk or not. Now, in this case, it is really low. It's actually as low as it was back in 2021, and so you should look at this with you should look at the markets and say, all right, the risk is low, which means that there's a higher probability of the stock market going higher. Doesn't mean it will, and certainly in the short term, it doesn't mean anything. But if you're looking at it for like 3 months, 6 months, 12 months, and you start to see this tick up, you might want to start paying attention. My guess is this will start to pick up the second half of the year, as I've predicted in the past, but we'll see. There's a lot of funny money floating into the stock market right now, so we'll see with the election coming up if that has any impact. Doug, you want to talk about the credit cards?
Yeah, I'm going to talk about. I'll talk about credit cards, but also just in case you want to come back to it a little bit. You were talking about gold. I put something in there to kind of show another thing that I think is misleading to a lot of people, which is understanding how.
Not this one, not that one,
not
different,
that
different
one.
picture.
But hey, as we're in the world of the bling cartel. No, it's to show that again, understand the investment. So if you have an investment in gold, is that gold in the spot price? Sorry, is it in the is it actually holding tangible gold? And some investments do hold some tangible gold. Very few investments that you can get into in terms that are tradable are going to hold a significant portion of tangible gold. A lot of it's still going to be a combination of that futures, but also understanding a little bit more about the fact that a lot of these investments are actually either investing in not only a lot of much tangible gold, but they may be blending or exclusively investing in miners. Okay. And there's a significant difference between the two that can actually be beneficial depending on the time in which that investment is actually occurring. So some people would think that obviously if gold prices are going up, then that would naturally lead to better performance of gold miners. That is certainly true to some degree. If the gold miners are sitting on gold, then any increase in the valuation of gold is going to be an immediately better opportunity for those gold miners. It doesn't, again, if it gets too expensive and people are, and they're in unaffordable, then again, it doesn't matter what the gold value is, they're not going to sell it. But if they can sell the gold at a higher price, yes, any gold that they were sitting on is going to be better for their bottom line. The other side of that, though, is when gold prices go up too rapidly, it also means that, again, very bullish. If you think about what was happening with oil as well, whenever there is a higher demand and it is driving up the price of that, it also means that they will need to then go into the ground and mine more of that resource, whether it's oil or gold. That ultimately has a cost to it. So depending on the circumstances, depending on how rapidly there's a spike in gold, it can actually be a negatively correlated impact to the valuation of gold miners, because it can actually become more costly to go and continue to extract more gold to meet that demand than it actually is in the benefit of the pricing that they're getting on that. And I just wanted to kind of show that chart there, because as it showed, at least right now, and not necessarily because of anything I just said, there is a significant difference right now between the spot price of gold and gold miners. And so if you are investing in a mutual fund or an ETF trying to get exposure to gold, you need to be very careful to understand what you're investing in, because I can tell you this for a fact, being in, having been in this industry for a long, long time, that many of the investments out there that are gold investments are actually heavily driven towards gold miners. Okay. And that will have an impact on the performance, and it may not correlate directly to what's going on for the, in gold in general. Okay. Could actually be negative.
So before we get to credit cards, I want to
going back.
Doug.
Yes, please.
When you're talking about gold miners are basically the performance of gold miners is typically gold on steroids. That's how they're considered. It's leveraged gold. So if you think gold's going to go through the roof, that's why I invest in the miners. Now, does that mean that they're a good investment? No, they're a terrible investment. Gold miners are terrible, and especially juniors. They're the worst investment on the planet. You're basically, you have a thesis that there's gold in the ground, and you're going to go spend a ton of money to go figure that out. And if you're wrong, you lose a ton of money. It's like
it's wildcatting.
Wildcatting, exactly what I was going to say. So if you're looking at that, you're basically speculating on whether there's gold there. And if there is, you make lots of money. If there isn't, you basically lose. So it's a lottery ticket, an educated guess lottery ticket, but nonetheless. And so when you have these gold miners, you have the explorers, you have the mid tiers, and then you have like the large producers. And basically it's like the biotech sector, where the people who invent the stuff, then they go sell it to the big boys and girls that have the infrastructure to sell into the channels. Gold's much the same way. You've got the Newmonts in there that are basically just like they're not out really exploring. They're just pumping out gold. The problem with gold and any commodity, really, any non-renewable commodity, any sort of metal, you're pulling it out of the ground. At some point, you run out of that metal, right? If you got a field full of corn, next year you plant more corn, but you can't plant more iron or gold or silver. So it's a depreciating asset. You're buying an asset that's going to go away. So mining companies are a terrible business. Can you make money in them? Absolutely you can. And there's actually some business models that have nothing to do with pulling assets out of the ground that actually are more financial related and are really good investments. I'm not going to get into it here, but the point is there's a lot of opportunity there, but you have to be mindful of it. You can't just assume, oh, it's gold, it's a good idea, let's do it, because these mining companies aren't great investments. But people do run the price up when gold goes up, because the mining companies make more money, right? If you expected $1,000 an ounce and now it's 2,000, well, you're making a lot more profit. So these companies do end up growing in price, but they're one of the junior miners are one of the most volatile assets on the planet until Bitcoin was created, and you could make lots of money and lose lots of money. It's not a good buy and hold strategy. It's a good speculative strategy or a trend strategy, but if it's not trending, stay away. You're just setting yourself up for failure. Go ahead, Doug.
Yeah. And I was just saying, at some point when the price goes up too quickly, it actually, because of the fact that they have to go speculate for more gold and cost to extract it, you will see that a spike in the price of gold could lead to a decline in gold miners. They have so many, as you said, a ton more variables. The biggest takeaway on this for those of you out there that might be investing is really understand what you're investing in, because this is one of the most misunderstood investments, I believe, that people can have in their portfolio, because many times a gold mutual fund or a gold ETF is either blended with or actually heavily built around investment in miners. And it is not the same thing. So you are not getting what you necessarily think you're investing in. Actually getting spot price and physical gold is extremely difficult in a lot of these investments. So, all right. So what I wanted to kind of turn it back to credit card delinquency. I'm going to touch base on a couple of things here that are all very correlated. So Kirk can keep up with me on the chart. But we'll start with the credit card delinquency. It has just been reported that it is at the highest rate of record, highest rate on record ever for delinquency. It's a record 3.5% of U.S. card balances were more than 30 days past due at the end of last year. And that's according to the Federal Reserve Bank of Philadelphia. That might have a little bit of insight into that data.
Just a little bit.
And this data goes back to 2012. So as we talk about chart crimes, again, we say highest level ever. Maybe it isn't, right? Because 2012 isn't that big of a scale. It could have been much, much worse, because this doesn't even take into consideration 2008. So let's put a little bit of a pause there on what that means. But if we look at the most recent economy, which really, let's face it, since 2010, nobody remembers what happened before. You could tell everybody about 2008. Most investors have gotten completely complacent to that risk, okay, and that economy, because we've been in the arguably, I'd have to look if it is the or close to the longest bull market in history. And then you add in the influx of capital that came from 2020, people are spending. But when people are still seeing cash offers being going, I'm going to come back to the real estate side of it if we have time today. But when you look at the cash that's out there, people are I believe are a clear misunderstanding of that everybody there is just feeling good, because you go to the mall, you go to the stores, and you're just seeing more and more and more spending. Okay. A series high of nearly 11% of account holders are just making the minimum payment as consumers are continuing to struggle with inflation and the higher cost of living it brings. And that's not going to get any easier, according to Sherwood, an author for Sherwood who does this financial reporting. But because, listen, right now, credit card interest rates are averaging from commercial banks 21.6%. Okay. So just because you're seeing people out there spending, doesn't, remember, you can pay for something that's $5,000 and only have a payment of $500 a month. And they may be able to cover that, and that may be all they're covering. But the problem is the average consumer is getting hit every which way. They also just reported that retirement is looking more pricey for most. They basically did a survey, and this came from Northwestern Mutual via the Wall Street Journal, looking at what the cost of retirement would cost per generation. The baby boomers are certainly sitting in the best position, as they already have the most assets and they don't have as far to go to live in retirement. So just under $1 million in 2024. Actually, for them, because their window is getting shorter, it's actually better than it was 2 years ago. They need less. But for the rest of the generations out there, and of course, this is calculated based on how long they have till retirement and through retirement, it has actually been increasing steadily, at least over the last 3 years. What is interesting in this is that millennials have an even higher cost of retirement than Gen Z. And I believe, and again, remember, this is based off of a survey of U.S. adults. Some of this may come into different factors and expectations and lifestyles. Gen Z, I'm not going to get into the generational differences too much right now, but they based on when they came in to the economy, based on what they faced, they have for the most part kept a lot of their expenditures down. They've been much more conservative on their expenses. They've saved a little bit better. They have less debt. So that is absolutely a positive. You can see the huge spike out there, though, that's still coming for them because they have the longest duration to be able to both save and retire. Now, going back to what contributes to those longer term costs, but also what's contributing to the credit card delinquency, let's just wrap this piece that I'm talking about up with the CPI. Okay. Consumer price index came back in and it shocked. I don't know who it shocked because I'm not sure it shocked you and me, Kirk, but I think it shocked a lot of people. We've been talking about this for quite some time. Oh my gosh, it's still expensive over there. Oh my gosh, rising interest rates haven't diminished. Just because inflation went down by a tick for a bit doesn't necessarily mean the problems were gone. And one of the things that came is that in March, it rose to 3.5% annually, up from 3.2 the month before. And now we're starting to see a consistent trend of the CPI going back up. And you're probably noticing this if you're watching the markets at all, investors don't love the news because it actually pushed expectations of rate cuts further out. But markets have short memories. And of course, the S&P 500 is actually flattened out a little bit. The bad news is, you're starting to see the cost of things like a new car haven't changed that much. But the problem is that's not necessarily where all of the inflation is coming from. If you take a look here, where are prices still rising? Number one, motor vehicle insurance is far and away the biggest. And the thing is, that's not necessarily tied to any real tangible correlation that people are able to put their finger on. It's not like this is happening in markets where there's higher car thefts. It's not like there's happening in markets where cars have been flooded. Just overall, the insurance has gone up. And I'm going to put something out that's a purely speculative assumption. But one thing we have talked about, Kirk, is that we have looked at commercial banks and we have looked at what they're dealing with unrealized losses based on where they invested money that they're putting returns on. Correct? We've looked at this a little, quite a bit. So they're paying you interest on your savings account. They're taking the money that they've collected from savings and investing things. And a lot of these banks made a significantly poor decision of investing in things that, unfortunately, in U.S. Treasuries, which then got beat up by rising interest rates. Well, unfortunately, and if you don't mind leaving that chart back up for me, because I'm going to come back to it again. But unfortunately, what happened in the insurance world is, and especially what might be happening in this is, guess what? These property and casualty insurance companies may be, and I'm stressing maybe, doing the same thing, taking their premiums, investing those premiums in conservative investments that may also be potentially facing unrealized losses. Now, this could be something that's much more a conspiracy, but the issue is it tells you the tightening of what they see as a higher risk. Number two is motor vehicle repair. Guess what? We're not buying new cars. And if we're not buying new cars, guess what's going to happen? You're going to have to pay more to keep the existing car working. There's only so many people that can do those repairs. That is a supply and demand issue. Healthcare is still up there. Rent is still up there. Utilities, housing, food away from home, transportation. These are what we call necessities. Okay. Look what's happening to the bottom line, the blue. A lot of the things on here, airline fares are finally going down as the wave of travel is diminished a little bit. College textbooks have actually gone down as they've probably gone more from hardback to digital. Televisions are going down. Used car and trucks have gone down. New vehicles have gone down because the demand for buying them, it's too expensive. So, and of course, car and truck rental is also tied to that vacation. So guess what? Everything is going up in the areas that we need to spend on. For example, your household bills are likely stubbornly climbing. Rent, housing, electricity, all up an average of 5 to 6% in the last year. But again, travel and other things are going down. So there's some good news. If you wanted to go in and go across the country, instead, if you catch a plane or rent a car on arrival, you're seeing those down 7%. Overall, though, again, these are the things that are easy to eliminate because they're the wants. But the needs, you've got to keep your vehicle working. That is a need. You've got to insure it by law. That is a need. If you get sick, you got to go to the hospital. That is a need. You have to pay for housing. You have to have electricity in that housing. You have to pay for food. So the issue is, I want to bring that all back together because if credit cards are already at their extreme valuations, okay, and we're starting to see that the more and more consumers are only paying the minimum because of their affordability and the cash flow, we are at a potentially, again, there's no absolutes here, but potentially at that breaking point that we've been talking about for some time that will trickle up from the bottom, but the bottom is definitely feeling the pressure. And ultimately, it only takes a little bit more movement to be able to cause that to crack. Now, wanted to say one last thing that might help a little bit of that. The current administration just announced another massive forgiveness of student loans. As a matter of fact, I think it's 220,000 people were just forgiven student loans of something like 153 billion dollars so far since January 2022, 4.3 million borrowers. But just in the last couple of days, they announced another $220,000 will be forgiven, and this one did not actually tie to any income. So you're starting to got to see some people that were getting some loan forgiveness even based on higher incomes. And again, I said several months ago that if all of a sudden student loan management started to come back into people's budgets after the continual post-COVID deferment, that was going to make it easier to avoid or at least ignore the impending pain. Now, obviously, a little bit of a reprieve there. Again, many of you listening may feel very politically different about this view, but ultimately that will lead to some help and reprieve out there as a positive to those that may be facing the greatest financial difficulties.
I don't know about you, Doug, but after seeing that, I want to go to college. I mean,
Absolutely.
I don't know why, but I just want to go to college because why not? The government will just do it for free and they'll just let all these loans go to zero and I don't have to pay for anything. Yeah, let's just rack it up.
You don't
have $1 million in college debt and I'll cross my fingers and hopefully the government pays it off. And if they don't, well, then my life is screwed. But hey, let's hope. Let's vote. Let's vote for the.
If they don't, Kirk, thankfully they've got income-driven loans now that allow you to borrow whatever you need and as much as you can get. You go ahead and borrow $250,000 to $300,000 in loans for that $25,000 a year career that you're going after because, hey, you're only going to have to make a payment based on that $25,000. Forget that you'll never be able to pay off that loan for the rest of generations unless it's forgiven. But hey, at least on a monthly cash flow basis, it'll be an affordable loan, which of course, don't think for a second, the colleges don't see that as an advantageous way to continue to charge.
Yeah, I think the whole college process is so beyond corrupt. And I mean, frankly, I think this is just a political way for Biden to get reelected. And, I get it. I mean, it is what it is.
Imagine if he did that in an election.
I know, imagine.
Wait.
Wait, I guess. But anyway, so what's interesting is, I mean, there's obviously a lot of heated debate around this, and we're not going to get political, but I think that if you really kind of break down the issue to its essence, some people say, well, it's going to cause massive inflation if you forgive all the loans. And I mean, we already have massive inflation. They're already printing money like it's going out of style. So I actually don't object to that. I mean, I do philosophically, but compared to what else they're doing, I just say, whatever, right? The thing I object to actually is the, just based on principle, is the unintended consequences or the moral hazard issue of this, that it comes in. I mean, think about it this way, right? If you have a high suspicion that you're not going to have to pay for college, then why do you care at all? And then why doesn't the college just keep charging more and more and more? And it's just a way for the people to kind of like milk the government and colleges to get rich and all these people get rich. And it's like, who's paying for it? And we are, all of us. And people, I think this is one of the challenges. And for people who don't understand inflation, it is one of the worst things out there economically. It destroys our economy. It destroys our country, but it doesn't do it overnight. It does it over like 100, 200 years. And so the problem is that people don't respect it because it's like, oh, it's only 2 or 3% a year. Well, as Doug showed, it's not 2 or 3% a year. And what he also pointed out, which I loved, was, yeah, it's 3.5% CPI. But everything that you actually use on a daily basis, transportation, housing, electricity, rent, hospital services, that's all higher than 3.5. So I'm curious, what are people spending that is balancing out to 3.5? because my life is going up well more than 3.5. Everyone I know is the same. So where are they getting the 3.5? That's why people don't trust the government numbers, is because they don't make sense, right? If you actually put the math together, you're like, I don't think so. That doesn't add up for me. But regardless, like I said, the world isn't flat today. So, you know,
Says who?
a certain percentage of the population does think that. But if you really kind of like look at the repercussions of getting college loans forgiven, it's a massive problem. It basically says you have no liability for your actions. Oh, you made a bad decision? Oh, don't worry about that. You won't have to pay that off. Oh, well, let me just go make another bad decision. And so people get upset about Wall Street, like Wall Street in the great financial crisis. They got bailed out because they had to. The whole system would have imploded. And people are like, why are you paying off the bankers? Why are you paying off their bonuses? Like, I agree. I'm not in disagreement. Why do that? Right? They shouldn't have, but they did. And so bankers still got paid, even though they destroyed the financial system, and they still got paid for it. And there was a lot of money printed, and everything was forgiven. But when it's college, people don't object to that. Oh, it's college. It's too expensive anyway. Like, all right, well, who's the villain? Well, we are, because we're the ones who have to pay for it. It comes out of the government. It doesn't come out of the college's pocket. It doesn't come out of the finance company's pocket. It comes out of our pocket. Our pocket is the Treasury, the U.S. Treasury, all of us collectively. And I'm going to paraphrase this, but there was a quote that said that democracies last as long as people don't realize they can vote themselves a percentage of the government treasury. That's basically it. Once you realize you can vote yourself a percentage of the government treasury, meaning in common terms that we all pay taxes every year, and the second that we realize that we are owed a percentage of that government treasury, that amount of taxes, then our democracy ends, because everyone's just got their hand out and they just want free money. And you can make decisions about whether it's right or wrong. We're not here talking about right or wrong. Like there's no fairness in life. Life isn't fair. It'll never be fair. So fairness is not a standard you can abide by, because there's no such thing as fairness. But if you're looking at what's the right way to run an economy, it's not forgiving money for making bad decisions. People, they did that with housing, the great financial. We do it a lot, and so I don't think this is a good trend. It's not going to stop, I don't think, because people are just going to expect it now, and then it's just going to make the problem worse. College costs will go up. We won't have to pay for it, and the people who are responsible, they're going to have they don't get the benefit. So it's just this weird system that it no longer benefits the free market, and it just keeps getting worse. So I do think that a lot of people are worried about this, that the economy is in rough shape and it's going to blow up. It's not going to blow up tomorrow. Is there a day of reckoning? Absolutely. But it might be 10 years from now or 20 years from now. But it will happen. I haven't talked a lot about it in the show, but I do have this marker about 10 years from now. I think there's going to be big financial economic problems in our country and the markets. But I think that's not going to happen today for various reasons, and we can get to that in the future in the show. But we're going to wrap it up here in the interest of time. I got to jump here. So, Doug, where can people find more about you?
Well, here's the thing, Kirk. We just spent time talking about the impact of costs of college, and obviously the impact of taking on loans and the hope for forgiveness. And again, we could get into an entire conversation about accountability. And I think that's something that as a society we're really struggling with right now, is accountability for actions. But I want to segue really quickly on that topic about college again, and go back to Heraclitus of Ephesus had a saying known as "change is the only constant," and of course that has been rewritten by people like Bob Dylan as "times they are changing." Well, it just got announced that Harvard is, as they just published through their own Harvard Gazette, is going to start implementing a requirement to have SAT and ACT scores once again starting in 2029. Okay, so yes, so and this follows Dartmouth and follows several other colleges that have already done that. Okay, so here's the thing: how do you keep up with it? College is extremely confusing. We just noted it's extremely expensive. based on no accountability and forgiveness and income-driven payment plans, these colleges still have basically no incentive to do anything other than keep raising their prices, because the federal government's going to go ahead and back it, and then you get to deal with the repercussions later. Listen, you can't afford the repercussions. Credit cards are maxed out. People are stressed. Inflation keeps going up. The only way that you can solve the college cost problem is to have a plan for it and to be aware of those costs and go into it with some very, very specific goals that you want to accomplish. And if that's the case, you need to get your information. So I'm just going to say this, and I've said this on every meeting. If you're not going to procollegeplanners.com, procollegeplanners.com, we are going to be updating this soon to a different website. I'll let you know, but for now, go to procollegeplanners.com. Get the information and come talk to us, because as we just said, you can't afford not to. Know what you need to know, and you can't afford not have the information and get the help.
Well, thanks, Doug. I appreciate you coming on the show. I'm going to share one more point. We're going to wrap it up because we're long in the tooth here. But I did want to point out that for the first time, I think ever, according to this article, that the Federal Reserve has actually lost money. They actually reported a loss, primarily because of their bond portfolio. But I just found that interesting. First time in history, Fed reported billions in losses weekly, still paying high interest rate income to mega banks on Wall Street. Now, granted, that's a little inflammatory because they're blaming on the big banks, but there's a lot of truth in that. And so we'll talk about that a little bit next time. But it's a fascinating story, and this is what gets into the accountability. And I think people don't realize the decisions they make do have repercussions, and this is one of them. So
that's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, wealth manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.